We're going to look at exercise 7 in this recording. We're asked to do 4 things, and in particular, it's really asking us to connect certain items on the income statement with the related account on the balance sheet. For instance, in item A, we're asked about supplies expense and given some information about the asset supplies account and to problem solve for something in that account. Likewise with B, we're asked about insurance expense and have to recognize its related prepaid insurance account. On C, salaries payable, which hopefully you recognize would be related to the salary expense account. And then on D, we're kind of asked about the unearned revenue account and kind of somewhat connecting it to service revenue. So let's pull up. So really a good way, if we're trying to analyze accounts, is just to really set up the related balance sheet account and the T account. So we have the supplies account in A, prepaid insurance, the payable account, and unearned revenue. What I want you to think about right now is, well, what goes in these accounts? I mean, um, all of these accounts will have a beginning balance and they'll have an ending balance. But what is it? What's the activity or what's the transaction that's going to cause supplies to go up and cause supplies to go down? Well, I hope you recognize that supplies will go up when we buy supplies and supplies will go down when we use the supplies. And of course, when we use the supplies, it creates an expense. Likewise with prepaid insurance. Well, what causes it to go up and what causes it to go down? Well, it's very similar, isn't it? It goes up when we buy the insurance, it goes down when we use the insurance and insurance expense. Now let's go down and look at these these two liability accounts. Salary and wages payable, it's going to go up because we used salaries, right? And we owe money for it, right? So we have salary expense, and the offset to that is creating a salaries payable. Or if you prefer, it's when we debit salaries expense and we credit the salaries payable account. So it goes up because we owe money for salary expense. It goes down because we pay them out. So all payables go down when we actually pay cash for them. Unearned revenue is a little bit different, isn't it? It's going to go up not because we pay, but actually because we have received cash in advance. So unearned revenue goes up when a customer prepays in advance or we receive cash in advance, and so we owe services. So it goes up because we receive cash in advance, and the reason it's a liability is because we owe services, goods and services for that. And then it's going to go down when we provide the goods and services. If we provide goods and services, we earn the revenue. So let's go over that again. It goes up because we receive cash in advance, and so we owe goods and services. That's the liability. And then it's going to go down. The liability goes down because we've earned the revenue. Okay, so let's look at the accounts now. So here on this page, I've really set out, so for an A, let's look at what we know then. So if we go back to our little problem, we can see that the ending supplies balance is 700, supplies expense is 950, and then they also tell us $850 of supplies was purchased in January. Well, let's go put all of that in our account then. So again, we know that the ending balance according to the trial balance is 700. We know they tell us in the narrative that they purchased 850. And then we also know from the trial balance that that they used 950. So they purchased 850, they used 950, and they ended up with 700. So you're just doing your arithmetic, what plus 850 minus 950 will give us $700. And we can solve for our $800 beginning balance. 800 and 850 gives us 1650 minus our 950 gives us 700. Okay, you might want to work ahead and see if you can do B on your own. For B, we have insurance expense is $400. The original insurance premium was for 1 year. What was the total premium when the policy was purchased? So we can see prepaid insurance, we ended up with $2,400. And we can see the monthly expense on that is $400. So let's go back and look at our T account. So let's put that in here. We know 2400 was the ending, and we know the monthly expense is 400. Well, just kind of look at those numbers. If we're ending up with 2400 and the monthly rate is 400, how many months is that? Well, 2400 divided by 400 gives us, excuse me, not 600. So the total months at the end would be 6 months, wouldn't it? So this $2,400 actually represents 6 months of insurance. So apparently, somewhere along the line, we probably had a beginning balance of 2,800, right? All right, so there again, they're asking for how many months, and we could solve for that to be 6 months. All right, let's move on to C. For C, we see if $2,500 of salary was paid in January, what was the balance at December 31st, 2013? So notice that's really the beginning balance, isn't it? So they want to know on January 1, which is December 31st, what was the beginning balance? So we can see the payable at the end is 800. We can see the expense was 1,800 and that they paid 2,500. So we're just going to take that information and put it in here. So again, we know the ending balance was 800 according to the trial balance, and we also know the expense was 1,800, and the narrative told us they paid 2,500. Okay, so we know 3 of 4. Anytime we know 3 of 4 unknowns, we can just solve for that fourth unknown. So you know what? Plus 1,800 minus 2,500 will give us 800, and you should solve for $1,500 there. So 15 plus 18 is 3,300. Subtract your 2,500, and that'll give us our $800. All right, last one has to do with the unearned revenue account. So let's go look, see what they want us to do. If $1,600 was received in January for services performed in January, what was the balance in the unearned service revenue account? And again, notice it's December 31st, 2013, so they're really asking for what was the beginning balance. Well, let's look at the related accounts. We know the ending balance of unearned revenue is 750. We know service revenue is 2,000, and again, we know cash collected for revenue was 1,600. So let's go look at what we got over here. Well, I've already kind of put some of that in here. We know that service revenue was $2,000. We also know from the narrative that 1,600 of that was for cash. The other thing this particular problem does, but it doesn't tell us this very well, but we have to make this assumption because there was no accounts receivable on the trial balance. So they don't sell, apparently they don't sell on account. So we can discard that there wasn't any revenue due to sales on account. So do have to make that assumption. So there's really 3 ways, right, of recording revenue. It could be sales on account. It could be that we sold the product for cash, or it could be that the customer had prepaid and then later we delivered the goods and earned the revenue, right? The 3 timings of revenue. We can earn revenue before we receive the cash, which creates an accounts receivable. We can earn the revenue at the time we collect the cash, or we can earn the revenue after the cash is received. Again, before cash, at the timing of cash, or earn it after cash has been received. And in this case, we can see there was $400 then that was earned after the cash was received. The other thing the narrative tells us is that there was $750 in our ending unearned revenue account. So we can figure out that if that's the ending, and then we earned $400 out of the unearned revenue account during the year, then the beginning balance must have been, drumroll, $1,150. And we're assuming there was no cash collected for this unearned revenue account. So $1,150 minus 400 gives us the ending $750. And the one thing just ending that I want you to recognize is how helpful the T accounts can be for problem solving. So if I'm asked for, to solve for something within a T account, within an account, set up the T account. It's a good way to go.